You're with us here in India today. We're counting down to Budget 2022. What's in store? And the big word, growth. What's in store for growth as we track the booster shot budget? Saurav Majumdar, editor, Business Today magazine, also joining us as we count down. Saurav, every expert that we speak to, every market analyst, every policymaker only has eyes on one thing. What is the growth trajectory going to look like? What is the fiscal deficit glide path going to look like? What's your anticipation or expectation from the finance minister this time?
Yes. Abha, I think the most important point, I couldn't hear your question very well, but I must say the expectation is very clearly that, here will be a budget which will be helping in creating jobs. It will be also, putting expenditure in the into productive uses. We would hope to see something on disinvestment going forward, because that's been a story which is not playing out very well. And of course, it will be good to see something really importantly being done on the MSME sector, which is extremely stressed.
Saurav, welcome. It's going to be a long day for all of us. This is Nirmala's fourth outing, the 10th budget for the Modi government. Before the numbers, really a macro overview from you. What should this budget be delivering, given the overall context, given what is happening to the economy, all of those points that people talk about?
Siddharth, I think the basic thing would be that while there is fiscal headroom, because the revenues have been very, much buoyant this year, there is a lot of fiscal space for which the government can play with. But there is also this whole business of not being able to spend adequately. So there is a lot of money which is there, which is not being able to be spent adequately because of projects not being pushed through because of the Omicron and the pandemic in general. So I think there should be, a very clearly balanced view where you put expenditure in productive uses, like I said, but also eventually remember the fiscal glide path as well. So I think it is an important balancing act which the finance minister will have to be putting together in terms of both expenditure to push growth and get the economy continuing to grow at the economic survey talks about 8 to 8.5, but I think the general consensus is it may not be that high. But then, you'll have to have that balancing act.
Let me also bring in Anant Narayan, banking and financial markets expert. Anant, I want to take that point forward. A very good morning to you. There has been some criticism that there hasn't yet been enough spending. I think we're looking at about 50% of the total outlay so far. What is the delay? What can we expect this time around? What should the priority be when it comes to spending? And also, from a banking and financial services point of view, are you watching out for any key announcements this time, whether it comes to PSP capitalization, whether it comes to any kind of digitization or tax relief for the financial sector?
Good morning and happy budget day to you and all your viewers. Look, on the first point, I completely agree with the previous speaker. I think the good news which came out was actually yesterday on the numbers for the union budget, the accounts as of December. The revenue collections are looking fantastic.
Yeah.
And it looks like for the entire year, they might end up with revenues 3 lakh crores in excess of their original budgets. That gives them a lot of fiscal space. Of course, for this year, there are also additional expenditures, fertilizer subsidy, food subsidy, Narega. There's also the Air India issue, which I think will incur some cost. So there is enough fiscal space available. The revenue collections are looking good. That's the first part. The criticism about less expenditure so far, again, in December, the expenditure has picked up. I think this government is serious about at least fulfilling its commitments as far as capital expenditure is concerned. And on the revenue expenditure as well, in December, we saw a big pickup. Yesterday's economic survey talked about bearable strategy. I think it's a euphemism for saying we're going to spend everywhere. I think they're definitely going to spend, and therefore I'm not so concerned about the spending bill. I'll tell you what I'm looking forward to, both for this year as well as the next year, more importantly. Given there seems to be buoyancy on the revenue side because of this formalization, which is really impacting us and helping us, we can't forget the fact that the bottom half of the pyramid is really struggling. There's a lot of pain. Unemployment is a definite problem. So we need jobs. We need domestic output. That needs a lot of money into infrastructure. The National Infrastructure Plan needs funding, both from the fiscal side as well as from other sources. Second thing, the point you made about things like privatization, things like trying to bring in more private capital, we have to see progress on that. Unfortunately, since the last budget announcements, we've not seen progress on the nationalized or the privatization of the two nationalized banks, the insurance company. Hopefully, I think she might announce the progress on the IPO of LIC today. So the two things I'm looking for is, one, a dramatic continued increase in capital expenditure for next year as well. I'm expecting a 20% increase over this year. I think expenditure even this year will catch up. Central expenditure, they're really pushing hard. I think it will catch up.
Right.
Third, I'm expecting some directions on things like privatization. Are we going to continue with that same vigor that was promised in the last budget, or has the politics changed and therefore will we be a little more circumspect? I expect them to announce a roadmap for definitive privatization across multiple sectors.
Well, Anand, that's a very important point, but let's go back to the point that you made about excess revenue over budget estimates. And if you look at the tax GDP ratio, the total tax GDP ratio, which was estimated, was 10.8%, not perhaps as high as the peak years in the current context of FY17 and 18, but very, very significant. So that's going to be a very important number to look out for, because that gives the government of the day fiscal headroom. It also allows them to do more as far as schemes are concerned. And then one very quick follow-up point with you as we look at these numbers. The key issue really is, how do you spend the tax windfall? Is it to be taken for fiscal compression, or does it mean that this money should be utilized going ahead for continuing with measures to support growth?
I think they'll do a bit of both, Siddharth. So first of all, while I'm exulting at this numbers on tax collections, it's because we've got used to seeing actual tax revenues come well short of budgets. So kudos to the the finance ministry for the last year. They've given us very reasonable projections, and now we're going to end up beating those. I think even with the improved tax GDP ratios, it's going to be marginal. It's going to be about 11.2% or so. So we still have a long way to go in terms of improving tax to GDP. But yes, it does give us room. I think a couple of things gives us room for both fiscal consolidation as well as for expenditure. One is the nominal GDP, Siddharth, is going up. It was projected at 222 lakh crores last year. It is going to end up at 232 lakh crores. Next year could be 262 lakh crores. So as your denominator goes up, your fiscal situation starts to look better by itself. So, even with the same fiscal deficit number, which was projected last year, you'll end at not 6.8%, but 6.4% of GDP, which looks great. Second thing is, I think they will continue to expand. Last year, they showed a very definitive push towards capital expenditure. I'm expecting, as I said, that push to continue this year as well. So to that extent, I don't think they will scrounge down on expenditures. At the same time, because your GDP is expanding and because your tax to GDP seems to be improving, I think they will continue to show fiscal consolidation of 6%. So to answer your question, I think they'll manage both. Show fiscal consolidation maybe to 6% of GDP from 6.8, which is a definitive move. At the same time, have, let's say, 20% increase in capital expenditure. One last quick point, Sid. The area I'm really worried about is states. While we are exulting about the center, the fact is states actually spend far more than the center does, particularly on capital expenditure. They are not getting enough funds overall. And frankly, their finances are a bigger hole than the center is at this point in time.
That's an important point, and perhaps we will see another 5-year extension to the cess, but that's a subject outside of the budget. Coming back to the budget numbers, and as we count down, less than 3 hours now, and joining us, Dr. Subhash Chandra Garg, former finance secretary, a person who has prepared several budgets. Morning, welcome to India Today. Dr. Garg, the big question, what is it that you are looking out for, and what is it that you are not hoping happens in this budget?
Let's put it this way, the budget, including the budget speech, is all sealed. So whatever has been done is now going to be sort of read out, presented. You can't do any change anywhere. So I would rather sort of postulate or in a way estimate, speculate that what might be in the budget. From that point of view, I was listening to this discussion on the revenue. I think this is fairly sort of argued. My own estimates are also that on the revenue side, on the taxes, we'll probably see on both the corporate taxes as well as the income tax, probably an increment of about 2 lakh crores. On the customs, we are also seeing some increase, but excise might be slightly down. And on the GST side, CGST, again, there might be an increment of about 50 to 75,000 crores. So all put together on the taxes side, I see increase of about 2.5 lakh crores. On the non-tax also, there has been good developments. RBI dividend was higher. Then you have even the revenue receipts from the telecom side, spectrum revenues, area payments have been better, and dividends have also been higher. So I expect that the non-tax revenue receipts, which were estimated at 2.4 lakh crores in the budget, should come close to about a lakh crores more, so 2.4, 2.5, which then will probably be compensating the downsize in the disinvestment side, depending upon how do you put the numbers for the LIC. Government may put a little more optimistic note on the disinvestment. So instead of revising, let's say 1.75 crores to 75,000 to 80,000 crores, which is more reasonable in my opinion, it might do about 1.10 or 1.20 lakh crores.
Right. Mr. Garg, so let me pause you there and I'll come back to that point. Key numbers that you highlighted when it comes to divestment and the trajectory there. Punita Kumar Sinha also joining us, founding partner, Pacific Paradigm Advisors. Punita, good morning. Great to have you with us. Markets, are keenly eyeing this budget. Everybody wants to know whether we're going to continue to see the kind of momentum that has built up. And even in the economic survey, the government highlighting the kind of wealth generation through IPOs, preferential issues, and the kind of momentum that stock markets have seen like never before. What's required in order for us to see that continue this time around, despite the global backdrop?
Well, great question. I think it's going to be very difficult for the Indian markets to continue to rally given the global backdrop, just based on the budget. So the budget will have obviously some positive or negative short-term impact, but then it'll become business as usual for the markets, and we will start focusing on all the things that we normally focus on: what's happening to growth, what's happening to valuations, interest rates, inflation. So I think one of the things that I would like to see is that the budget is not inflationary. So some bit of incentives more for the PLI schemes, etc., because that's proven to be quite successful. I think we really need to keep addressing the supply side bottlenecks, especially due to COVID as well, and to have more production in India. So I think that's going to be important, and also to make sure that our fiscal deficit numbers don't grow, rather they show directionally a consolidation. Otherwise, our real interest rates are negative, and we do need to see that our interest rates don't have to go up sharply. I think those are the two things that I think are going to be important from a market perspective. Of course, growth is always the focus, and I expect the budget to be growth-oriented given the forecasts that they've made for the next few years. So the other two factors, I think, are going to be important.
You touched upon inflation, Punita, and there was already a slight warning with regards to imported inflation, talking about oil remaining between 70 to 75. That's a safe zone as of now. Do you think that's realistic?
Well, I do think that, it's hard to predict what oil prices are going to do. But I think given what the commodities have done last year, oil has potential to go up, especially in the wake of some of the geopolitical issues that the world is facing. In those kind of situations, typically oil can go up. And if oil does go up, that's all the more reason that the budget factors that in appropriately and doesn't, see more inflationary or higher deficit numbers, and that the growth numbers are appropriately managed.
Let me come back to you, and this is to do with the point of execution. Two examples. The bad bank, it took almost a year, days before the budget for the final announcement to happen. We can go back in time, the pension bill amendments pending from the year before. All of that said, the ambitious plan on infrastructure is execution an issue, because when we see some of the line items, we see that in the first 8 months, expenditure growth has actually been lower than what was projected for the current financial year. Saurabh Majumdar, that question was for you.
Okay. Siddharth, I think you've actually hit the nail on the head. I think it's a very important point that expenditure, like I said at the very beginning, needs to actually follow the announcement. There has to be real expenditure on the ground. There have been multiple reasons why this expenditure has lagged in some form or the other. But I think that is important. That's on the one side. Second point I would like to make is absolutely what you said in terms of the implementation of the large announcements, for instance, the National Monetization Pipeline. That's a 6 lakh crore plan, which is quite interesting, which is quite detailed, but the taste of the pudding, lies in the eating. So if you do not actually take it forward in terms of the structuring of some of these, some of these assets, making them attractively priced so that there is investor interest, I don't think that's going to work, just by announcing those plans. The government's intentions, even like we said in the magazine, are noble on the monetization front. They do want to push it through. Air India, like we all know, is a very important breakthrough which the government has actually undertaken. It shows the resolve that they are willing to actually tinker even with the structure of the deal and so that it becomes more attractive to investors. So I think all of that needs to be done, because if you have 1.75 lakh crore in terms of announcements and target, and 9,500 crore or thereabouts at this point, or a little more now that Nilachal Ispat has happened, you really need to push, step on the gas on that front. Monetization, privatization and disinvestment, these three engines have to fire.
Derek, let me come back to you. Now, there are a lot of assumptions built into this math, and I was hoping that you could shed some light on it. I mean, you, of course, were taking us through the divestment numbers, but let's take a look at the kind of math they outlined yesterday. They're assuming a normal monsoon, assuming, of course, constant momentum on exports, assuming a gradual tapering, assuming that margin on oil. There are a lot of assumptions built in, at least into what we saw in the economic survey, if that's any indication of what's to come today. And I want to get a sense from you on whether or not that was really off the mark. As you said, the budget's already sealed and it's going to be delivered soon. But in terms of, whether you feel that was any indicator and if that was even close to what can actually be delivered. Dr. Garg, that was for you.
Oh, I see. See, in terms of delivery of the budget, I think we should, there are some very important developments which we should keep in mind. Number one, the budget on the expenditure side, roughly about 15 lakh crores out of 35 lakh crores is where the government has nothing to do, interest payments, pensions, and what is transferred to the states. So what is left, about 20 lakh crores, is where the government need to do. On that, one important development is on the food side. So food subsidy, which was planned to be about 2.4 lakh crores, is
we seem to have lost that link with Dr. Garg. We'll come back to him. I want to go to Saurav once again. Saurav, one of the issues also that we have witnessed during this current year is the threat of inflation. We have seen some words from the RBI, but very clearly there is a tough balancing act that the monetary authority also has to do in the year ahead as far as inflation is concerned. Do you expect a significant round of tightening in the months ahead? Saurav Majumdar, that question is for you.
Yeah, Siddharth, I think inflation is a very real risk. It's a clear and present danger. The point is that you have more or less, as I would think, from the policy side as well as from the corporate sort of corner room side and bottom lines, we've more or less figured out how to deal with various waves of the pandemic. Even the second wave, which was very debilitating otherwise, was fairly well managed by the companies, and Omicron was slightly milder, so that's been a slight bit of a relief. But inflation, like the RBI has warned, is definitely an important threat which is looming. Most importantly, imported inflation, because there is going to be, there is this whole oil prices, threat playing out. There is the, gradual. They expect orderly withdrawal of liquidity globally, but that's wishful thinking in some sense, I would think. So far it's been all right, but I think that's going to be a threat going forward, all of which will have a bearing on inflation. Now, RBI has over the last 2 years done a very good job, I would say, in terms of pushing and sort of playing along with the government in terms of matching whatever the government has done in terms of stressed sectors, easing liquidity, and the whole gamut of steps which RBI has taken over the last 2 years. But this year, RBI will have to, I think, necessarily look at a tightening of rates so that the inflation threat is addressed. And I think that's going to be a key challenge for not just the government, but and the companies, but also the governor. How he will manage it,
Right.
what time. Timing is critical, Siddharth, as you know, and you've covered this sector economy for a number of years. I think timing is critical.
Absolutely.
We do not want to be behind the curve on that one. Right.
All right, let me bring in Hiren Ved, Director and CIO, Alchemy Capital Management. Hiren, a very good morning welcome to this power-packed session that we're having just as we count down 2.5 hours to go before we actually see what's going to be in the paperless budget this time around. Hiren, from a market standpoint, what is the big theme that you expect to play out? Is it going to be infrastructure? Is it going to be rolling out that capex? Is it going to be an eye on reform? What, according to you, will be the big trigger this time?
So I think, Abha, I think very clearly from a market perspective, what the market would be looking for is growth, right? And I think that the growth impulses were set in motion in the previous budget. I think there is reasonable fiscal room. I wouldn't say that there is too much room because we fell short of divestment. But I think since revenues have tracked ahead of estimates, thanks to inflation and good corporate performance, my sense is that more spending on capital investment, aggressive divestment is something that the government is something that the markets will look for. And I think from that perspective, just letting or getting the growth impulses more momentum is what the markets would look for. I think in terms of reforms, while budget is important, but I think now reforms have in many senses been decoupled from the budget, right? So I think we've seen a raft of PLI schemes which have been announced even outside of the budget, and maybe a few more maybe talked about in this budget. So I think in many senses there is the only thing that the market would look for is consolidating on the growth impulses that were set in motion last year.
And that's a really important point that you also just touched upon, and we'll come back and talk more on that. How we can also see a further impact when it comes to manufacturing, build on those PLI schemes and lead to, of course, more jobs. Let's take a look at some of the key metrics that we're going to be watching out for as well, and some that have transpired. Let's take a look at those inflation numbers. It will be a key talking point as to how the finance minister has factored this in to the math of this budget. We all know that CPI has been rising. And take a look at that screen in front of you as well. You'll get a sense of how we've been seeing that build up on inflation. And primarily, of course, we're also seeing edible oils. That's the major chunk of why we're seeing that spike coming in. So can it moderate? Can it be kept into control? What are some of the actions that can be taken? That will be a key talking point. 5.3 is what we're looking at right now. That's the key number to keep in mind when it comes to inflation figures. Another important metric will be, of course, spending on healthcare. Let's pull that up for you. Remember last year's budget, this was a very, very big part of the budget. Given that we're coming out of the third wave, they've already, of course, factored in quite a substantial sum of expenditure continuing on healthcare. But what will be the step now going forward? That's going to be the big question. Actual expenditure, just taking a look at that graph, has come down post the peak. What will be the continued outlay? What will this mean in terms of proportion of overall revenue that they're allocating towards healthcare expenditure? That will again be an important question that we'll wait to hear answered.
All right, let me go to Anant Narayan, who's been waiting by patiently. Anant, one of the key concerns is what is going to happen on the oil front, and that impacts our import bill and in turn the currency. What's the outlook for the currency according to you?
So that, look, there are some things we can control, some things we can't. Unfortunately, both inflation, particularly with relation to commodity prices, and things like edible oil prices, and things like global shortage of chips, etc. Frankly, there's not much that we can do in the short run to control these things, and we have to take what is dealt out to us. I guess the question really is, when it comes to inflation and imports, what is it that we can control within in our economy? Here is where the concern and the link to the budget is. While we exult about more government expenditure, and we want them to spend more on capital expenditure, for instance, or on healthcare and education, all good causes. The problem also is when the government spends and borrows money to spend, it creates money that in turn creates demand, and that in turn can create both imports as well as inflation. Unfortunately, as a country, we've not done very well in meeting the demand that's created by creation of money. Every time, for instance, see last year, from September onwards, our trade deficit has started to cross $20 billion per month on average. And a lot of it, by the way, is not just gold and petrol. It's also things like electronics. It's also chemicals. It's also plastics. It's also a whole bunch of manufactured products. So the moment we see some demand coming through, and in this case, from the top of the pyramid and the top of the K-shaped recovery, immediately translates into imports rather than from domestic production. So, two real things that we need to do. One is, of course, lay the ground for domestic production and employment to go up. Which is why it all boils down to what are you pushing into infrastructure and creating an enabling environment for MSMEs and manufacturing to pick up things like PLI, etc. I think that's very, very critical, because unless we create our own output to meet the demand created by fiscal spending or by monetary policy, etc., we will always be in this loop of inflation and current account deficits, etc. On the currency, Siddharth, look. At the moment, the balance is looking a little skewed. We are seeing very, very high trade deficits on a monthly basis. As I said, $20 billion per month. If you average that, that becomes $240 billion in a year. Services exports are looking very, very good. So even if we get $150 billion of net invisibles, we are still left with something like $90 billion of current account deficit. That's a 3% current account deficit. Again, we have plenty of reserves. RBI is sitting on $635 billion of reserves, so no problems on that front. They can manage currency markets, and I think they will manage currency markets in the short run. However, over a 3-4 year period, if we consistently continue to import every demand that comes up in the economy, this is not good news at all for us, neither from a jobs and output perspective, nor from an inflation perspective, nor from an external balance perspective. I think that's the real bottom line. whatever you do in the fiscal policy, yes, you have to spend money right now, but make sure it translates into jobs and output so that we don't get into this loop of inflation and trade deficits and current account deficits.
All right, several key points there. We have both Hiren and Punita also with us. Let me come to you, Punita, on this, because another criticism is that what we're seeing right now is really a K-shaped recovery or uneven recovery. There's been a lot of talk on what can be done for the unorganized sector, for MSMEs this time around. So while on one hand we have the government tom-tomming the amount of wealth generation that we've seen in this last year in the capital markets, on the other hand, the criticism is that it's not a broad-based recovery. What would you like to see in order to ensure that the needle moves ahead now going forward?
Two important things that I think we need to focus on. The organized sector is obviously showing great resilience, and I'm on boards of lots of companies. But there too, we are seeing some headwinds. The headwinds are coming from wage pressures. So wages are going up. So to the extent that people have jobs, I think the wages are increasing, so they are able to manage in an inflationary environment. But the companies obviously are going to focus on margin pressures. We're also seeing raw material prices going up for companies. But still, nevertheless, the revenue growth has been strong. But going forward, I think the revenue growth might be strong due to growth. I think margins could be under pressure. Now, on the unorganized sector, the MSME, there is still a lot of pain there. And a lot of that is because of COVID.
I'll have to cut in here because we are seeing visuals live that just played out. That was the Finance Minister Nirmala Sitharaman entering North Block just before the cabinet meeting that will take place around 10:15 a.m. and then the budget presentation at 11. Abha, I want to quickly take a point with Mr. Subhash Garg. Mr. Garg, for the entire concerns that we are expressing, oil prices, food and fertilizer prices, overall inflation, but the bigger issue is private consumption. Private consumption still being lower than pre-pandemic, and private consumption, as you know, makes up almost 55% of our GDP. Can there be anything that you expect to give a boost to private consumption?
See, the private consumption by the government is basically in the form of either transferring some cash or the support in the form of kind, or give some employment income in the form of the NREG, etc. There is no other direct measure which the government undertakes in the budget. The policy sides are different. So in this, the NREGA continues to be attracting a lot of demand. This year also, it's under budgeted in my judgment. So you would see increase in the NREGA, and next year also, assuming that the same kind of situation would continue, because there is a very large section of workers who are either not getting employment or are facing the wage loss situation. In the organized sector, there is a good increase in wage and there is wages pressure. But in the unorganized, which is roughly about 70-75% of the employment market. So I think government can continue to provide budget for the NREGA. The demand side is being met basically by sort of providing the food cheap or the free of cost. There would be a major decision to be taken because this food subsidy, the free food scheme runs out on the 31st of March. But what do you do next year? Should you continue with it or not? You have another problem because you're sitting on, you buy about 100 million tons of food grains, but your food security schemes takes about 50-55 million tons. So you can't leave it with the FCI and incur cost of carriage only. So I think...
Let me bring Hiren in as well. Hiren, private consumption, want to see a boost on ground, jobs, consumption. These will be, some of the key themes. And in terms of really what tools the finance minister has, what do you feel it's more realistic to expect? Where do you feel the priorities will lie among some of the sectors that are likely to benefit from Budget 2022?
Yeah, so I think there is definitely a need to boost consumption at the bottom of the pyramid. One way to do it is to increase the allocation to Narega, because there was a lot of job losses in the unorganized segment, also in many of the service sectors, and we have yet to see full resumption of employment opportunities there. So I think maybe if you remember many years back there was a concept of an investment allowance reserve, right? Which means that if companies did capex, they got a tax break. I think some kind of a employment allowance reserve could be very interesting, which encourages companies to hire people, and if they hire more people, there could be tax benefits that could be availed. And I think some form of income transfer, whether through Narega or some of the other, even through the Krishi Kisan cards, if there is more credit and money which is available to the bottom of the pyramid, I think that would be very, very useful, because clearly urban consumption has done very well, but rural consumption is clearly flagging. And I think, to some extent, stimulating consumption at the bottom end could actually help manufacturing, because as capacity utilization goes up, companies will then want to do more capex. So I think there are tools available to the finance minister, for putting more money in the hands of people at the bottom of the pyramid.
Hiren, one quick point with you. The real estate story, and we have seen so much play out during the Modi years. Affordable housing was a theme, but one gets the sense, if you take a look at some of the data and anecdotally, that affordable housing hasn't done so well because a certain kind of strata has suffered job and income loss in the last 12, 18 months. Do you expect anything for affordable housing and an uptick in that particular segment of the sector?
So I think, housing has always been in focus in every budget, right? And I think every time to encourage more housing, there are more tax exemptions, etc., which are given. But as you rightly put the nail on the head, it's not about tax benefits or making it more affordable. It's about people having incomes to afford a house, and that can only happen through greater employment generation. So I think one other area which India keeps talking about, but we haven't really seen any specific measures there, is to enhance industries like tourism, right? Which are very, very employment intensive. And I think that's also one sector which has suffered very, very dramatically because of COVID. And I think if there is some targeted benefits that are given to service sectors like tourism, restaurants, small scale industry, I think that would go a long way in kind of boosting incomes.
Right.
And then indirectly their housing.
Right. Shankar Iyer, welcome to the show. It's going to be a long day for you as well. I want to begin by your opening comments, really. If we go beyond the budget a little bit, when it comes to the overall play of business, the last couple of years, especially post the COVID pandemic, have been years where big business has gotten bigger. Small business, which has received support, for instance, through measures like the emergency credit line scheme, is still struggling. What is the theme that you think will play out, and what will work for the Modi government from a political economy point of view?
Well, ideally, this is going to be a budget where messaging balance will have to be achieved. So you'll have the finance minister will try and message to the industrial and manufacturing sector and to the larger economy that they will keep the growth impulses going. And given the fact that there are elections in 5 different states and Uttar Pradesh being very critical, they will also have to message that they are being the bottom of the pyramid
Are you
is
making
being
a
looked up.
distinction between messaging and concrete measures, Shankar?
Well, budgets are normally, Siddharth, largely about messaging, because at the end of the day, and Saurabh Garg is there, he will tell you that, the central government is at the most can issue sermons on Sunday, and the rest of the 6 days, it is the state governments which have to implement. And currently, state governments are sitting over between 4 and 5 lakh crores, which is unspent, which I think is completely unpardonable, but there it is. So I think the messaging, coming back to your question, the messaging will be about, so the government, in a way, it's a good place to be in, because private final consumption expenditure is still below 2019 levels. So how do you prop that up? So your title of your budget program is booster shot. And I think the one big issue that will come that the finance minister will have to speak about is how much of the country is vaccinated and what is the road ahead there to ensure that the contact
Shankar, very quickly, isn't it time that the vaccination theme doesn't get overplayed? The productive parts of the economy, in a way, the urban areas, the factory workers, all have been double vaccinated. So how much more can we continue to push the vaccination theme and perhaps also realize more money through cesses on that account?
Well, next to Omi Bhai or his cousin, somebody might surface, a new variant might surface. So the government has to take a call on how they will ensure that contact economy gets going. So somebody spoke about tourism, hospitality, aviation, and a large part of the retail, the small businesses. They're all being hit because there is this constant fear of people are not coming out, and even if they are coming out, then there are government restrictions. So how the economy is going to open up?
Let me take that point very quickly. Let me take that point with Subhash Garg. Subhash Garg, explain to our viewers the reluctance, and I use that word consciously, to intervene for those who are immediately impacted. In the current wave, we have seen, whichever way you describe it, restaurants, hotels, tourism take the brunt of the third wave. It's a wave that has perhaps receded, and that's good. Why is there this reluctance to provide immediate support? It's good that you have long-term targets, investment, infrastructure, capacity building, but why not some immediate relief?
See, in my judgment, there are two reasons. One, the most impacted segments in this contact-intensive services or the trade businesses, hospitality sector, are the small businesses. In fact, single account, on account kind of businesses where people work for themselves or with very small number of labor. Unfortunately, in India, we don't know them. We don't have any databases. We don't register them. We have excellent unique ID for individuals, 130 crores, but we have 8 crores of such businesses, but we don't know them. We don't register them. So it's our inability to reach out to them. That's one. The other one is I think the reluctance of the government to sort of dispense what was considered as kind of direct demand support or the direct cash or support to them.
Right.
The government has been reluctant to do it. It has gone through the guarantee route to give to the MSMEs, which are bigger ones, not the smaller ones. So I think
Dr. Garg, please pause that thought.